In this video, we're going to look at the cost of debt. So again, debt yields versus returns. There is a slight difference, I guess. The yield to maturity is the internal rate of return that you're going to earn if you hold a bond to maturity and receive its promised payments. Now, if there's very little risk that the company will default, then the yield to maturity is a reasonable estimate of the expected rate of return. However, if there is a significant risk of default, we do have to understand that the yield is going to overstate the actual rate of return. So how are we going to deal with this? So if you consider a one-year bond that has a yield to maturity of Y, for each dollar invested in the bond today, the issuer promises to pay 1 plus Y in year one, right? So if you invest a dollar, let's say Y is 5%, every year you would expect to get 1.05 or $1.05. You would earn $1.05 in every year. Now, what if there was a probability of default, P? Well, now you're going to get 1 plus the yield, but now there's going to be this potential loss, a loss of $1 of debt for every percentage here, and there's a probability that that will happen. So let's see how this will work. So the return on debt is 1 minus P, right, times Y, plus the probability now of the loss. And if you do the math, expand that out, the return on the debt is the yield minus the probability of loss. So how do we calculate this probability of loss? Well, on average, here's our rating system for our bonds. In just an average market, let's go down a way so we get triple B rated bonds have a default rate here of roughly 0.5% in average times. Now in recessions, that's 3%. So what we need to understand is there's a 3% chance that there will be some kind of default during the time frame. So the average loss rate for unsecured debt in the marketplace is roughly 60%. So if you take the B-rated bonds, let me just go back up here, the B-rated bonds, it's 5.5%. So what is the expected return for B-rated bond holders? You take that 0.055 multiplied by the probability of the average loss rate of 0.6, that gives us 3.3%. So if you take the yield to maturity and subtract 3.3%, that is the expected return, assuming the default rate that's potential. What about for Disney? The average yield is about 3%. They have A plus rated bonds. So the adjustment, 0.6 times from the table the 0.2%. So the adjustment is 0.12%. 3% minus the 0.12 tells us that the adjusted yield on Disney is about 2.8%. So this is what you expect to get, assuming default or the potential default. Now, we also can use the capital asset pricing model to determine the cost of debt. It's a little bit more difficult because of the infrequency of trading, but we can adjust this. We don't have to do the beta of the bonds themselves. Let's do betas of bond indices by the rating category. So we can create an index of the bonds that are all triple A, double A, triple B, double B. So we can then look at those betas relative to those bond indexes. So here's what we find this. We can do this by bond maturity, or we can do it by rating. So above here we have, if you're A and above, the average beta is roughly, it's less than 0.05. Triple B is 0.1, 0.17, and once you get down here, 0.31 is the beta here. We can also do it by maturity. The average beta by maturity, if it's between 1 and, this is for triple B and above bonds, is 0.01, 0.06 for double B, 0.07 for B, etc. So we have betas. So now we can plug this into our formulas, right? Here we have a home builder, KB Home. They have outstanding 6-year bonds. They have a yield to maturity of 6%. And they have a B rating. If the corresponding risk-free rate's 1% and the market premium's 5%, what's the expected return of their debt? So using the debt adjustment technique, 6% minus the 5.5% times the 60% here is 2.7%. If we use the CAPM model, it tells us it's roughly 2.3%. Both of these are obviously approximations, and they both confirm that the actual debt, the return on debt, is well below the promised yield, right? The promised yield is 6%. Looks closer. This is actually less than 3% is what we can expect to earn from this debt. So now let's change gears just a wee little bit. We know how to find the cost of debt. We know how to find the cost of equity. How do we utilize this when we're thinking about a project? So what is a project's cost of capital? So if you kind of look at this picture, we have a project. It's going to be, relatively speaking, if you look at these proportions, the assets of the project, if the company is going to use the exact same financing mix, they'll be very, very similar to maybe a comparable firm or to the rest of the company. So how do we do this? We need to find an all-equity financed firm, has a single line of business that's comparable to this project. And then we can adjust the numbers. Now, here's the problem. It's very difficult to find an all-equity financed firm anywhere, let alone a single line of business, right? So we're typically going to have to do this with leveraged companies. So here's what, if let's say, again, you have an MBA, you want to start a line of women's designer clothes, and you think that the company Michael Kors is the kind of company you'd like to build. So we want to develop our financial plan and estimate the cost of capital of this opportunity. Again, risk-free rate's 3%. The market risk premium is 5%. So again, if we look at Google, what do we find? We find that Kors has almost no debt, and they have an estimated beta of 1.13. So if we use their beta as an estimate, we can use that previous equation. So the cost of the project is the risk-free rate plus the systematic risk here. We would expect to get a return of about 8.65%. Why does this work this way? It's because, number one, we're assuming almost or very, very little debt. So the cost of the project is really the cost of equity. So if our project will provide a return greater than 8.65%, then we should move forward. If not, if we can't earn more than 8.65%, but we are interested in the women's apparel businesses, we then should just buy core stock, and it should give us around that 8.65%. So let's expand this a little bit further now to companies that might actually have debt, right? So how do we do this for them? So the expected return to investors, right, it really depends on the costs, the returns to those investors. So the weighted average of the company's equity and debt, this is how we calculate it. Here's the return or the cost. Here is the proportion of equity and the cost of equity, the proportion of debt and the cost of debt. How do we do this with beta? We can also do it with beta, where we have the beta of our company is the proportion of equity times the beta of equity plus the proportion of debt times the beta of debt. So let's work through an example, see if we can figure this out as we go along. So let's assume our company looks a lot like P&G. P&G's equity is 144 billion of debt, 37 billion of 144 billion of equity, 37 billion of AA rated debt. They have a beta of 0.57 and an average yield of 3.1%. And again, we're assuming risk-free rate's 3 and the market risk premium is 5%. So let's work through this problem. What is, or how can we calculate the unlevered cost of capital? In other words, how do we unwind this so that we can find out what would their cost of capital be if it was unlevered? So R sub U here, again, here's the proportion of equity, proportion of debt. 5.85% is the equity cost of capital using that capital market line. 3.1% is the yield that we're given for P&G's debt. So their cost of financing roughly is 5.29%. Now, what do we know about P&G's debt? If we can assume that their chance of default is very, very low, right? We can adjust this a little bit and calculate the unlevered beta. Assume that the beta is 0. So this part of our beta calculation is going to disappear. So the beta of the company is the proportion of equity times the debt, or times the beta, 0.453%. So we can look at our project's cost of debt. Well, assuming we're not going to have any debt, it's 3% plus that point. So our 5.27 is our project's cost of capital, assuming no debt. Now there's a slight difference, right? They're slightly different. And this all has to do with how we look at the promised yield of the returns, right? If we assume the debt has a beta of 0, again, the truth is the result's somewhere in between those, right? It's somewhere in between those two numbers. Now, we do have a worksheet that can help us calculate this asset beta and unwind the debt from one company and put that into another. So here's what we have. Here was beta for P&G was 0.57. Here's the debt and equity. So the pure play debt equity for that is 0.256%. When you unwind that, so the pure play equity beta, right, without the debt is 0.453. Now we want to take that and put it into our company, assuming our debt equity mix. If we assume we want 0 debt, right, so it's 1 to 0 here, the project beta again is this 0.453. Plug that in, we end up with again, that project's expected return of 5.267%. So essentially what we can do here is take this company that has debt, unwind the debt, and then put in our debt. Well, what if we wanted to do twice the debt as we have equity? Then we could put in 2 to 1 here. 2 to 1 would then lever up this project beta. The beta would increase, the project's beta would increase because now we have debt. And of course, when that increased, that would also give us an increase in the project's expected return. This is what's frequently referred to as the Hamada equation. So again, we have gone through this process. We've shown how can we find the cost of equity, how can we find the cost of debt. Now, how can we apply that to a project? So for right now, I look forward to talking to you in the next video.